Imagine this. The market suddenly expands, the Bollinger Bands open wide, candles stretch aggressively, volatility explodes, and every new trader thinks a massive trend is starting. But what if I told you that this exact moment is often the end of a trend? What if I told you that when Bollinger Bands expand the most, the market is quietly preparing to reverse, and professionals are already positioning themselves against the crowd? Today, I'm revealing a powerful hidden Bollinger technique called the Bollinger Dark Zone Reversal. This is not the squeeze, not the basic touch the band setup, not the usual breakout trade. This is a setup based on volatility distortion, a moment when the band expansion itself becomes a warning signal. Stay with me till the end because the entry rule in this strategy can transform how you look at price. Most traders use Bollinger Bands as a beginner tool. Touch upper band, sell. Touch lower band, buy. Middle band equals moving average. Squeeze equals breakout. But this surface-level usage misses the true depth behind the indicator. Bollinger Bands don't just measure volatility. They reveal when volatility becomes unhealthy. And unhealthy volatility is the birthplace of reversals. That's where today's technique comes in.
Before we get into the rules, here's what you'll discover today. A hidden volatility window called the dark zone, why the strongest candles often mark the end of the trend, how professionals exploit failed expansions, a simple 3-step entry method you can use right away, and a realistic stop-loss and money management approach. Let's begin decoding this phenomenon.
The dark zone is a sudden area where Bollinger Bands expand aggressively, but the price movement inside them becomes irregular, unstable, or weak. In simple words, the dark zone happens when bands expand violently. Price stretches outside the bands. Candles look impulsive, but strength disappears immediately after expansion. The bands show momentum, but the candles show hesitation. This contradiction is the key. The dark zone exposes where liquidity has been hunted and where the market may flip direction. When new traders see bands expanding sharply, they assume, trend is getting stronger, enter quickly. But what's really happening? The market is running stops, triggering breakout entries, collecting liquidity, absorbing late buyers or sellers. And once that liquidity is collected, the smart money has no reason to continue the move. This creates the fake strength illusion. Let's break it down deeper. When volatility spikes, the band expands automatically. But the question is, does the candle close strongly outside the band, or does it close weakly back inside? That difference is everything. If price revisits the band quickly, prints small bodies, or forms long wicks, it tells you the expansion was not real momentum, it was a liquidity event. Markets accelerate to pick up orders, not always to continue trending. And that's why this strategy works beautifully across forex, crypto, commodities, and indices. Imagine a market trending down. Suddenly, you get a huge bearish candle that breaks outside the lower band. The band stretches downward aggressively. New traders jump in thinking the trend is accelerating. But look at what happens next. The next candle forms a long tail. It closes back inside the band. Volume drops. Momentum indicator slows down. Bands stop expanding and begin slightly contracting. This is a classic dark zone. The market completed a liquidity hunt below the low and now prepares to reverse. This pattern appears in all liquid markets. Here is the exact setup used by advanced traders. Step 1. Identify violent expansion. Look for sudden and sharp band widening. This tells you volatility has burst unnaturally. Step 2. Check for a candle breaking outside the band. This candle is the bait. It creates fear and greed. Step 3.
Look for the return candle. The return confirmation comes when the next candle closes back inside the band. It shows hesitation, and it does not follow through on the previous momentum. This is your entry signal. The return candle marks the exact moment smart money rejects the expansion.
Entry. Enter when the first candle fully closes back inside the Bollinger Band. This shows the expansion has failed. Visualize the setup in this screenshot. Stop loss. Place SL above the liquidity wick for short, below the wick for long. This is logical because the wick represents the liquidity grab. Take profit. Realistic targets. TP1, middle band. TP2, opposite band. Runner, trail beyond the opposite band if momentum continues. This method is stable and avoids over-expecting reversals.
Here's how to turn a good setup into a great setup. 1. Volume spike, drop. High volume on the fake expansion, low volume on hesitation. 2. Opposing wick. A long rejection wick shows strong fight from the opposite side. 3. Momentum divergence. Momentum slows while band expand, powerful contradiction. 4. Key session timing. Reversals often happen after major session opens or major news spikes. 5. Avoid tight ranges. The dark zone works best after strong pushes, not sideways markets.
Most traders use bands too literally. They trade touches. They trade breakouts. They trade contractions. But the deeper truth is, volatility behavior tells you more than price itself. The dark zone helps you avoid buying tops, avoid selling bottoms, avoid chasing momentum, catch real reversals early, and understand volatility manipulation. And this is exactly why professionals love this technique.
Here are the 5 core ideas you should take with you. The biggest band expansions often mark the end, not the beginning of a trend. A candle outside the band is not a confirmation, it is a trap. The return candle inside the band is your real signal. The wick of the fake breakout is the liquidity sweep zone. That's where SL goes. Targets should be realistic. Middle band first, opposite band second. Master this, and Bollinger Bands become a precision tool rather than a beginner indicator.